You could really feel a certain tension in the financial air lately, like something's maybe getting ready to give. We're seeing some really interesting moves in the markets, and that's precisely what we're digging into today.
Right.
We've got a collection of analyses looking at, well, everything from the climb in U.S. Treasury yields to what's playing out with Japanese government bonds.
And the deficit, too.
Exactly. Not to mention our own expanding budget deficit and some, let's say, curious actions from the Federal Reserve.
It has quite a mix.
So our goal today, our mission, is to try and connect these seemingly separate pieces, see if we can get a clearer picture of what they might be telling us about the financial future of the U.S.
It feels like a pivotal moment, doesn't it? We're definitely observing shifts across various parts of the global financial landscape.
Yeah.
And the crucial part, I think, is understanding how they influence each other, particularly concerning U.S. Treasury bonds, which really are, the foundation of the global financial system.
Okay, let's unpack this then. Starting with those U.S. Treasury yields. We're seeing both the 20 and 30-year bonds now yielding above 5%. Yeah. That definitely feels like a notable point, almost a psychological marker.
It is significant, yeah. While it might just seem like a number on a screen, that 5% level on the longer-term treasuries, it really signifies a market reassessment.
A reassessment of what exactly? Risk.
Of the inherent risks in holding U.S. government debt, basically. Think of it like this. A borrower with increasing credit card debt will eventually face lenders demanding a higher interest rate, right?
Right, to compensate for the risk.
Exactly. To compensate for the growing risk of default. That's essentially what the bond market is signaling to the U.S. right now.
Yeah.
And as one of our sources points out, the fundamental driver here isn't new. It's the long-standing gap between government income and outgo.
Right, the structural deficit.
For the past, 70 years, tax revenue has remained relatively stable, around 16% of GDP. That's the total value of everything our economy produces.
Okay, 16% in.
But government spending, that's risen from about 17% back in the 1950s to over 23% currently.
Wow, that's quite a gap that's opened up.
It is.
So it's this increasing difference between what's coming in and what's going out, right? I remember the analyses and mentioning the Clinton years were different.
That's true. That was an exception, a bit of an unusual period. We had a budget surplus then, largely thanks to the rapid growth of internet-related investments around the Y2K boom.
But apart from that brief period, we've generally been spending more than we earn. So is the bond market now essentially saying, look, this path isn't sustainable? Is that the message?
That's precisely the message those higher yields are conveying. I mean, the bond market is demanding a greater return to compensate for what it perceives as heightened risk.
Makes sense.
And our source also emphasizes that if this pattern continues increased spending without matching revenue growth, we're likely to see further downgrades of U.S. debt. It's a market-driven feedback mechanism.
And it's interesting that the analysis also brings out gold and Bitcoin as potential indicators here.
Yeah, the idea being that if trust in traditional government debt weakens, investors might look towards these alternative assets.
A flight to safety, maybe.
That reflects a classic flight to safety, or perhaps store of value mentality. If there are growing concerns about the long-term stability of, traditional currencies and government bonds,
then assets outside the system look better.
Assets like gold and Bitcoin, yeah, which are seen as having limited supply or existing outside conventional financial systems, can become more appealing. Absolutely.
Okay. Now, let's pivot a bit and turn our attention to Japan. We're seeing their government bond yields, JGBs, doing something the analysis describes as going parabolic.
Yeah, parabolic is a strong word.
It is, especially when the Bank of Japan holds a massive 53% of their outstanding bonds. That sounds, well, quite worrying.
It is indeed. The fact that yields are increasing so sharply despite such significant central bank ownership, that suggests a very powerful underlying market dynamic is at play.
So the market is overwhelming the central bank.
It appears Japan might be entering a phase where the true market value of its debt is being discovered, maybe with less intervention from the Bank of Japan acting as the primary buyer, sort of a free market price discovery phase.
And one of the pieces we looked at had some calculations that really highlight the potential pain for bondholders.
Oh, yeah. The example is pretty stark.
A 40-year JGB with a 2.2% coupon, now yielding 3.3%. I mean, the price has fallen significantly. We're talking about a potential 41.4% loss since just January of this year for anyone holding that bond. Ouch.
That really illustrates the raw impact of rising interest rates on fixed income investments, doesn't it? And it's amplified by the long duration of these bonds.
Long duration meaning more sensitive to rate changes?
Exactly. That long 40-year bond has a high duration, which basically means its price is very sensitive to changes in interest rates. Even a relatively small rise in yields can lead to a big drop in price, like we're seeing there.
Okay, but beyond the bondholder losses.
Well, the real time bomb aspect, as our source aptly puts it, is the combination of these rising interest costs with Japan's enormous debt load. They're at, what, 250% debt to GDP?
250%, yeah.
Servicing that much debt becomes much, much more expensive as yields climb. It's a dangerous spiral.
Okay, so Japan is clearly facing a serious challenge. But how does this tie back to us here in the U.S.? Because the analysis makes a critical point. Japan is the largest foreign holder of U.S. treasuries.
They hold over $1.1 trillion.
Wow.
And this is where the potential for wider impact for contagion emerges. If Japan faces increasing pressure to manage its own debt issues, and remember, they have something like $7 trillion worth of JGBs outstanding.
They might need cash.
They might. And one potential way to generate capital could be by selling off some of its holdings of U.S. treasuries.
And that could create a domino effect, right? If a major holder like Japan starts dumping U.S. debt.
It could put downward pressure on treasury prices, which means pushing our yields even higher.
Leading to that similar pain the analysis mentioned for the U.S. market.
Precisely. It feels like we're all participants in this multi-trillion-dollar financial experiment, whether we realize it or not. The interconnectedness is key.
It really is. Stresses in one major market can quickly spread. Japan's situation is definitely something to watch, given those huge treasury holdings.
Absolutely. It underlines the whole theme of rising yields we started with.
Okay, now let's bring our focus back home, specifically to the growing U.S. budget deficit. The analysis mentions the OBBB bill passing the House.
Right, potentially adding another $500 billion per year to the deficit over the next 4 years.
That's a significant chunk of change every year.
It is a substantial increase. And there's this idea floated that, increased tariffs from China will somehow offset this rise.
And I saw that mentioned. Does the math work?
Well, as our source points out, it simply doesn't stand up to basic math. Even with China's, $438 billion in exports to the U.S. last year, you would need tariffs exceeding 100% just to cover the increase in the deficit from that bill. Forget about the existing deficit.
Over 100% tariffs, just to cover the new spending.
Correct. And, negotiating tariffs at that level seems highly unlikely, to put it mildly.
So the idea of tariffs being a simple fix here seems pretty unrealistic then.
Very.
And the core message just keeps coming back to the same point, doesn't it? The U.S. needs to get its financial house in order to avoid seeing those parabolic bond yields like Japan is experiencing.
Exactly. The market's willingness to just keep absorbing increasing amounts of debt without a clear plan for fiscal responsibility, it's limited.
So the deficit is a big problem. Now, the source material did touch on some let's call them unconventional ideas that have been floated as potential fixes.
Right. Some rather unconventional and potentially problematic solutions were mentioned.
Like the idea of an FNMA IPO, maybe bring in $250 billion.
Yeah.
Or the one that really caught my eye, revaluing the U.S. gold reserves.
Yes, the gold revaluation.
Increasing the official price from, $42 an ounce up to $3,300? Sounds like a way to magically create $800 billion for the Treasury.
It sounds tempting on the surface.
But the analysis warns about inflationary consequences. How would that work?
And that's the crucial catch. If the Treasury were to revalue its gold and deposit that new value with the Federal Reserve, the Fed would essentially need to create new print money, basically to credit the Treasury's account.
So it's like QE again.
This injection of cash into the financial system would be very similar in effect to another round of quantitative easing. And as we've seen before, QE can lead to inflationary pressures.
Which pushes bond yields higher.
Potentially, yes.
Right.
Which could make the initial problem, the high cost of funding the debt, even worse. It's a bit of a circular problem, a potential trap.
It really does feel like we're in a financial mousetrap, as the analysis puts it. The ways out seem increasingly narrow and, frankly, filled with their own risks.
That description feels pretty apt right now, and it sets the stage perfectly for our final point. This idea of stealth QE and the Fed's recent activity in the bond market.
Okay, so traditional quantitative easing, QE, that involves the Fed openly announcing these large-scale bond purchases to pump liquidity into the system.
Correct. Very public.
Stealth QE, on the other hand, sounds more like the Fed is quietly intervening, maybe without a big flashing announcement.
That's the interpretation being put forward by one of the analyses. It highlights a recent Treasury auction.
What happened there?
Well, a significant portion of the offered bonds, something like $42 billion out of $120 billion, apparently didn't find buyers at yields the market considered acceptable at that moment.
So weak demand at that auction.
It seems so. And what's particularly interesting, or perhaps telling, is the Fed's subsequent purchase of a substantial amount of treasuries shortly after.
How much did they buy?
$43.6 billion, including a notable $8.8 billion in 30-year bonds and $20 billion in 3-year notes, seemingly in a single transaction.
Wow, okay. So the market doesn't take all the bonds, and then the Fed steps in and buys a big chunk. That definitely raises some questions, doesn't it?
It does. It suggests there might be weakening demand for U.S. debt at the current yield levels, or at least inconsistent demand.
And didn't the Fed also change how much debt it's letting roll off its balance sheet each month?
Yes, that's another key point. They reduce the monthly runoff, the amount of maturing bonds they don't reinvest, from $25 billion down to $5 billion.
So they're letting less debt disappear, effectively keeping more liquidity in the system.
Taken together, these actions, the post-auction purchases, the reduced runoff, support the idea that the Fed may be becoming a more active buyer again, perhaps in a less obvious way than traditional QE.
Almost like they have to prop up demand.
It suggests that investors overall might be net sellers, or at least reluctant buyers, of U.S. Treasuries at these yields.
So the Fed is really caught in a difficult position here.
Extremely difficult.
If they don't step in when demand weakens and yields keep rising, that just makes our deficit problem worse, right? Higher borrowing costs.
Exactly. It widens the deficit further.
But if they do intervene with this stealth QE, they risk reigniting inflation and maybe weakening the dollar.
That's the other side of the coin. It risks undoing some of the progress made against inflation and could undermine confidence in the currency.
It truly sounds like a choose-your-poison situation, as the analysis describe it.
That sums up the fundamental dilemma quite well, I think. The need to finance ongoing government spending is bumping up against the market's increasing reluctance to absorb ever-increasing amounts of debt at current prices.
And the Fed's actions suggest they're trying to navigate this delicate balance.
But it's clearly a precarious situation with no easy answers.
Okay, so just to recap for everyone listening, we're seeing U.S. Treasury yields pushing higher, above 5% on the long end, signaling market concerns about our spending outpacing income. Then there's the situation in Japan, soaring JGB yields despite massive central bank ownership, and their huge holdings of U.S. Treasuries acting as a potential risk hanging over our market.
A key connection, yes.
Meanwhile, our own budget deficit continues to grow, and these proposed quick fixes like massive tariffs or gold revaluation seem either unrealistic or problematic.
Right, no magic bullets there.
And finally, the Federal Reserve seems to be engaging in stealth QE, suggesting there might be underlying weakness in demand for U.S. debt, putting them in that tough choose-your-poison spot between higher yields or more inflation.
It all feels very interconnected, doesn't it?
Absolutely.
It really highlights the deeply interwoven nature of global financial markets. You know, challenges in one major part of the world, like the difficulties in Japan's bond market, can indeed have significant consequences for seemingly distant markets like ours in the U.S.
Yeah.
It's a powerful reminder that in today's financial landscape, no major economy truly operates in isolation.
And at the heart of it all seems to be this fundamental tension. The ongoing need to fund government obligations facing off against increasing debt levels and a market that's becoming, well, more demanding about the price it charges for holding that debt.
Which naturally leads to a final thought, maybe something for you, the listener, to consider. Given all these interconnected pressures we've discussed, the rising yields, the Japan situation, the growing deficit, the Fed's delicate dance, what might be the unexpected event? What could be the unforeseen trigger or catalyst that further intensifies these already strained financial market dynamics?
That's definitely something to mull over. What's the black swan hiding out there?
Exactly. What's the next shoe to drop?